Great. Good morning. Welcome to today's board meeting. We have one item on our agenda for today. It relates to an agenda consultation and agenda decisions related to equity method and renewable energy partnerships. So with that, let me turn it over to our team to tee us up this morning. Good morning. Ashley?
Thanks, Rich, and good morning, everyone. Purpose of today's meeting is for the board to decide whether to add a project to its technical agenda related to the equity method of accounting and/or renewable energy partnerships based on stakeholder feedback, including feedback received on the 2025 agenda consultation invitation to comment. The invitation to comment, or ITC as we will refer to it today, was issued in January 2025 to solicit broad stakeholder feedback about the future standard setting agenda of the board and summarized input from stakeholders received during the second half of 2024. On the basis of that outreach, the ITC included discussion on the equity method of accounting and renewable energy partnerships and questions for respondents, which are included in paragraph 3 of the handout. In teeing up today's discussion, we will first provide feedback on the equity method, including all feedback received on the hypothetical liquidation at book value method, or HLBV. That relates to both the equity method and renewable energy partnerships. This is because use of HLBV, while more prevalent in the renewable energy sector, affects the accounting for all equity method investments with complex earning structures. We will then separately tee up feedback on the proportional amortization method, or PAM, which is an accounting method specific to tax equity investments in limited partnerships, and was the primary area of feedback on renewable energy partnerships outside of HLBV. And so with that, I'll hand it over to Alden to provide a high-level overview of the current accounting for equity method investments and the stakeholder feedback received.
Thank you, Ashley. Investments in unconsolidated equity securities are typically accounted for under either Topic 323, which is the accounting for equity method investments, or Topic 321, which is the accounting for equity securities. The appropriate accounting model for these investments depends on the degree of influence that an investor has on the investee. Specifically, when an entity has the ability to influence the operating and financial policies of an investee, it is required to apply the equity method. This is meant to differentiate the accounting for investments where an investor is able to influence their return from those investments that are more passive in nature. However, the degree of influence that must be present to apply the equity method differs depending on whether the investment is in a corporation or a limited partnership. For investments in corporations, an investor is presumed to have significant influence when it holds more than 20% of the investee, unless there is a qualitative factor that indicates otherwise. In contrast, for investments in partnerships, the equity method is applied to any investment in that partnership unless the investor's interest is deemed to be so minor that it has virtually no interest. As further described in the handout, the virtually no interest threshold is commonly viewed in practice as 3 to 5%, which is based on an SEC staff announcement made at the EITF meeting for EITF topic D46, accounting for limited partnership investments. If the equity method is applied, an entity recognizes in their earnings their pro rata share of the investee's earnings, which will also increase or decrease the carrying amount of the investment. That allocation is generally based on the proportion of the investee's common stock. However, in situations where the investee has a complex allocation structure, determining the investor's share of earnings in an investee requires careful consideration of the substance of the arrangement, and entities will often use HLBV as a method for calculating their share of the investee's earnings. Use of HLBV is further described in paragraph 8 of today's handout. At each reporting period, the carrying amount of the equity method investment is also adjusted for other transactions, similar to the adjustments made in preparing consolidated statements, examples of which are included in paragraph 9 of the handout. If an investor does not apply the equity method, the equity investment is accounted for under Topic 321. Under that topic, an investor subsequently measures its investment at fair value every reporting period and includes unrealized gains and losses in earnings unless the investment does not have a readily determinable fair value and the investor elects to apply the measurement alternative. Under the measurement alternative, the investment is measured at cost and remeasured to fair value when it's impaired or when the investor identifies an observable price change in an orderly transaction for an identical or similar investment. I will now discuss the feedback received from the agenda consultation process, a summary of which is included in the appendix to today's handout. Approximately 1/3 of ITC respondents provided input on the equity method. Stakeholders generally provided mixed views on whether the board should address this area as a priority and, if so, how the board should address it. Those stakeholders that identified the equity method as a high priority generally noted that the equity method is unnecessarily complex and costly to apply, and they provided a variety of different solutions to address these challenges. Those solutions ranged from eliminating the equity method to making targeted improvements to the current guidance. Other ITC respondents that did not identify this topic as a high priority agreed the equity method can be costly to apply and therefore were open to standard setting in this area, but suggested that the board consider making targeted improvements to the guidance versus a holistic change. In contrast, the remaining stakeholders that identified this topic as a low priority said that the equity method guidance, while complex, is well understood in practice and provides users with decision useful information. In addition to the feedback received on the ITC, the staff also performed outreach with practitioners and advisory groups on the equity method. The feedback received from that outreach was generally consistent with the feedback received on the ITC. I will now pass it to Allie to walk through the staff's analysis of the FASB's agenda decision criteria.
Thank you, Alden. We will now discuss the criteria to add a project to the board's technical agenda, beginning with whether there is an identifiable and sufficiently pervasive need to improve gap. Although more prevalent in some industries, investors across all industries make equity method investments, and this issue affects any entity that holds equity method investments, including public business entities, private companies, and not-for-profits. On the basis of the stakeholder feedback, the equity method of accounting appears to be a top priority for many stakeholders, including preparers, practitioners, and trade groups. And this topic was one of the 5 topics most frequently identified as a high priority by preparers. On the basis of the feedback, the staff has identified the following key accounting challenges in the equity method of accounting, which are included in paragraph 11 of the handout. First, stakeholders indicated that the equity method of accounting can be costly and complex, for example, the accounting for basis differences. Second, many stakeholders said that identifying which investments should be accounted for under the equity method can be difficult. Additionally, many stakeholders struggle with the unintuitive outcomes that result from having different thresholds for evaluating significant influence in investments in corporations and investments in limited partnerships. Specifically, because the presumption of influence for limited partnerships is 3 to 5%, as compared to 20% for investments in corporations, stakeholders said that they often have to account for investments in limited partnerships that are actually passive in nature under the equity method only because they trip the lower threshold of significant influence. Lastly, stakeholders noted that there is a lack of authoritative guidance for how an investor should allocate profits and losses in complex allocation structures. The staff acknowledges that the extent of these challenges can vary by entity. However, on the basis of the feedback received, the staff thinks that this issue is pervasive to many stakeholders, as many stakeholders indicated that overall, the equity method was a high priority topic or that they were open to standard setting in this area. Therefore, the staff thinks that there is an identifiable and sufficiently pervasive need to improve the equity method of accounting. I will now hand it over to Edward to take us through the next agenda decision criterion.
Thanks, Allie. To address the key challenges that Allie just described, stakeholders suggested a number of potential solutions, of which the most frequently cited are described in paragraph 12 of the handout. I'll now briefly go through the staff's analysis of whether these potential paths could be cost-beneficial, technically feasible solutions, and also will provide additional commentary about alternative ways that the staff thinks the board could pursue a suggested path where applicable. Given some of the relationships and commonality among the 6 paths listed in paragraph 12 of the handout, I'm going to address them in a slightly different order than they are listed in the handout. Under the first path, EMA Potential Path 1 in the handout, the equity method would be eliminated and investors would be required to account for all equity method investments under Topic 321. As noted in the handout, this would mean that most equity method investments would be accounted for at cost less impairment unless there was an observable transaction, because many equity method investments are made in private companies. While some stakeholders supported this path, most stakeholders agreed that the equity method of accounting is the best method accounting for investments in certain industries and for investments that an entity holds to support its operations. Therefore, the staff thinks that this path would not be broadly supported by stakeholders and is not a cost-beneficial, technically feasible solution. The next path, EMA Potential Path 3 in the handout, explores changing the scope of the equity method to include only investments in certain industries and investments that support a company's operations, referred to as strategic investments. The staff thinks it would be challenging to define the types of investments that should qualify for the equity method of accounting. Notably, the staff thinks that it would be challenging to define a strategic investment and that creating such a definition would likely require significant management judgment and introduce new costs and complexities. To this point, the staff notes that the board made similar observations when it considered providing certain reporting exceptions for strategic investments and enhancing the reporting model for financial instruments in Update 2016-01. For this reason, the staff does not think Path 3 is a cost-beneficial, technically feasible solution. The next path, EMA Potential Path 4 in the handout, also relates to the scope of the equity method. But instead of considering whether there should be a holistic change to the scope of that guidance, it would reconsider what constitutes significant influence and whether there should be a single threshold for applying the equity method, regardless of whether the investee is a corporation or a partnership. The staff thinks that this path would address one of the key challenges noted by stakeholders, that there are unintuitive outcomes resulting from having different thresholds for evaluating significant influence based on the legal form of that entity. However, the guidance that establishes the different thresholds for a corporate form entity and a partnership form entity do not all originate from the FASB. Therefore, the staff observes that additional outreach would be necessary to better understand whether there is external support for establishing a single threshold of presumptive influence. For this reason, the staff does not think that this path meets the technically feasible agenda decision criteria at this time. However, if the board is interested in pursuing this path, the board could direct the staff to do this outreach. Under the next path, EMA Potential Path 6 in the handout, the board could explore making targeted improvements to Topic 323 to simplify the equity method of accounting, for example, by eliminating basis differences. The board has pursued projects before that focused on changes to simplify the equity method, including a project to eliminate basis differences that are removed from its agenda in 2016. The staff does not think that the board has received new information from when it decided to remove that project from its technical agenda, and therefore the staff does not think that this path would be technically feasible. The next path we'll discuss is EMA Potential Path 2 in the handout. Under this path, stakeholders suggested that an entity could elect to account for its equity method investment under a measurement alternative similar to the measurement alternative in Topic 321, if the equity method investment does not have a readily determinable fair value. Additionally, some stakeholders suggested this election could be developed as part of the fair value option in Topic 825, which is already available for equity method investments. That is, when an entity elects the fair value option for an equity method investment, it could also elect to apply a measurement alternative if the investment did not have a readily determinable fair value. The staff thinks that this path would address many key challenges raised by stakeholders while mitigating concerns raised by stakeholders in other potential solutions. For example, an investor that currently incurs significant costs to apply the equity method would be able to elect the measurement alternative. Alternatively, because the equity method would be retained, there would be no disruption to that accounting for other types of investments. Additionally, while stakeholders noted some concerns with an election to apply the measurement alternative, the staff thinks that these concerns could be mitigated through further development of the potential path. For example, the staff could perform additional outreach to better understand the practice issues noted by stakeholders in applying the measurement alternative and whether any changes should be made to that alternative. As another example, the staff could perform outreach with users to understand what current equity method disclosures users find useful and what additional information would be needed if some equity method investments were accounted for under a measurement alternative. Importantly, the staff notes that if the board were to pursue this path, it could explore whether an election should be available to all types of equity method investments or only a subset. For example, many stakeholders that supported EMA Potential Path 4 have provided feedback that certain types of investments currently are accounted for under the equity method that are really passive in nature and should be accounted for under Topic 321. Additionally, those stakeholders generally supported the equity method for investments that an investor is able to influence the return. Therefore, the staff thinks that the board could explore whether an election should be limited to only certain equity method investments. Or said another way, the staff thinks that the board could explore whether a subset of equity method investments should apply an accounting method that is different to the equity method and what that appropriate accounting method should be, for example, a measurement alternative. The staff thinks limiting an election could also alleviate concerns that users might lose information if true equity method investments were accounted for under a measurement alternative in Topic 321. For this reason, the staff thinks Potential Path 2, including the additional considerations just noted, could be a cost-beneficial, technically feasible solution. Lastly, under EMA Potential Path 5 in the handout, the board would clarify how an equity method investor should determine equity and earnings for investees with complex allocation structures. The staff notes that this path could be pursued by making broader changes to GAAP, such as by codifying HLBV, or by making certain targeted improvements to Topic 323 to address feedback that GAAP does not provide guidance for how an equity method investor in a non-real estate entity should allocate equity and earnings in a complex allocation structure. The staff does not think a broader project to codify HLBV would be cost beneficial. Specifically, many stakeholders indicated that the reporting outcomes from HLBV often do not make sense and that the guidance in the non-authoritative literature in which HLBV is described is difficult to apply because it is outdated and specific to real estate. Therefore, the staff questions whether codifying HLBV would be an improvement to financial reporting without undertaking significant rework of that literature. However, the staff thinks that a path that is narrowly focused on addressing feedback that GAAP does not provide guidance for how an equity method investor in a non-real estate entity should consider allocating equity and earnings in a complex allocation structure would be a cost-beneficial, technically feasible solution. Specifically, under a targeted improvements approach, the staff thinks that the board could explore the 3 items listed in paragraph 12E of the handout. Those are 1, moving paragraph 970, 323, 35-17 to subtopic 323-10. 2, adding guidance for how an entity should consider liquidation provisions that apply only in remote circumstances. And 3, adding an illustrative example that illustrates HLBV as an example of an acceptable methodology for applying this guidance. In summary, the staff thinks that EMA Potential Path 2 and EMA Potential Path 5, as the staff just described, could be technically feasible paths forward. I'll now hand it back to Ashley to go through the final agenda decision criteria and overall staff recommendation.
Thanks, Edward. Only a little bit more. The last criterion is whether there is an identifiable scope. The staff thinks that the 2 paths identified as technically feasible, path 2 and 5, have an identifiable scope because a potential project would encompass all investments currently subject to the guidance in Topic 323. Additionally, the proposed solutions are sufficiently narrow in scope to avoid unintended consequences. So in summary, the staff thinks that all of the agenda decision criteria are met, and it recommends that the board add a project to its technical agenda related to the equity method, and that the objective of that project should be to improve the operability of the equity method of accounting. The staff thinks that it is important to narrowly define the scope of this project on the basis of the technically feasible solutions. Therefore, the staff recommends further exploring a project scope that includes the scoping and measurement concerns articulated in EMA Potential Path 2 and EMA Potential Path 5, as Edward just described, and therefore would entail First, exploring whether a subset of equity method investments should apply an accounting method that is different to the equity method. Secondly, clarifying how an equity method investor in non-real estate entities should determine equity and earnings for investees with complex allocation structures by exploring the 3 recommended changes in paragraph 12E of the handout. If the board decides to add a project on the equity method to its agenda and agrees with the staff's recommended scope and objective for that project, the staff will further develop the details of the project for discussion at a future board meeting, including performing research and outreach with practitioners, preparers, and users on the paths forward. And so with that, I'll hand it back to Rich to open up discussion on questions 1 through 3.
Okay. Thanks, team. Robust tee up for us. I think the way I look at this is we're going to make a decision to add a project, give the staff some general direction to come back to us with to make decisions on. That's kind of the way I see it, because I have an idea that people aren't necessarily clearly in path 4, path 2 at this time. They want to understand more, or path 3 or path 5, whatever it is. They want to understand more about it and what the ramifications would be to make a decision in a future meeting. But giving you some direction on adding a project and what direction we're interested in you exploring, I think is helpful at this time. Does that make sense? Okay. All right. With that, Sue? Yes, Christine?
I had some questions for the staff before,
Okay.
if that's okay. I had some questions about the nature of the problem that the staff thinks is pervasive within the realm of the equity method of accounting. So as I went through and looked at, the feedback that we heard, there was a series of potential problems, but I couldn't really tell if all of them were viewed as pervasive or any of them were viewed as pervasive. So let me just walk through the 3 problems, because I can't go forward in determining, whether we should add a project or not unless I understand what the problem is we're trying to solve. So did the staff conclude that there is a problem with the equity method being pervasively applied to investments for which the investor does not have significant influence over the investee?
Yes, I think that's correct. So I think what we'd heard is that there are some investments that are being required to apply the equity method of accounting, where they don't actually truly have significant influence over that investee. Like when we think about the qualitative factors of significant influence, and in those entities, there's a lot of unnecessary cost and complexity that's not necessarily giving decision useful information to investors.
Right, but that's really more of a scope problem than just cost and complexity associated.
Yeah, I think we definitely heard that there's also cost and complexity for all equity method investments. I think maybe the difference to those investments that are more like true equity method investments is that cost and complexity might be necessary to give users useful information when it is more of a strategic investment that's aligned with the company's operations.
Okay, so that brings me to the second problem then, which was, were we hearing that there is the problem of the cost of applying the equity method pervasively exceeding the benefit? But I think what you just said was maybe for a subset, but not kind of overall.
That's right. Yeah.
Okay. And then did we get the sense that the complex allocation structure problem and the difficulty in allocating profits when there are complex structures, was that a pervasive problem as well?
That is challenging for the entities that have to apply the complex allocation guidance, but I think there was varying levels of challenges. So the one we heard is so in GAAP today, there's only one piece of guidance in the real estate, section 970-323, that alludes to that complex allocation guidance. Because that's in the real estate guidance, entities analogize to that more broadly when they have non-real estate entities. And then also they are using HLBV by analogy, which is not established in GAAP at all.
Right.
But there are also challenges in applying HLBV as well as a methodology.
Okay, but is that are those complex allocation structures common in these sorts of investments?
Yes.
Okay, that's what I was trying to understand. Thank you.
Yeah, and maybe just one additional point. The real estate guidance, particularly related to LPs, and it's been extended to LLCs, was based on the theory that the owner had an individual ownership account. And therefore, they didn't go through, that's the fundamental basis for 78.9. They didn't go through a significant influence threshold. They simply said, you have an account, you're going to get earnings accumulated to your account. Therefore, we don't care what the threshold is. They ultimately came up with 3 to 5%, but then I think muddied it a bit by saying, if you have less than that, you don't have any significant influence, but it was never really a significant influence threshold. Then we have the non-real estate entities who are sitting in our general equity accounting guidance who have this significant influence threshold, and it doesn't scope out partnerships. And so when you had an LLP or an LLC, they were theoretically doing something else. Some of the confusion has come about because some, particularly the regulator, has said, we expect everyone to follow that real estate guidance, even for non-real estate entities. I think that was the first bit of confusion. I think the second bit is even if they don't follow that, sometimes when you look at these complex allocation formulas for partnerships in particular, they are often real estate focused. So the solar farm or the wind farm that have them, they're real estate. And people sometimes don't realize they're real estate. They think they're simply investing in something to get some tax benefits and maybe a small amount of earnings. So sometimes they end up in the wrong place. But I do think that's the fundamental question. If we decide to add it, we might want to answer, which is, do we think that non-traditional structures, so LLPs and LLCs, should apply the equity method solely because they have ownership accounts, and we therefore are doing the accounting based on the ownership account? Or should we be raising this back up and saying, no, we're looking to see if you have significant influence over the entity? And if it's significant influence over the entity, you might say, well, we don't need different rules for LLPs and LLCs, right? And the other thing that I think is interesting is it talks about GPs and LPs, and LLCs are probably even as common, if not more common, and we don't mention it. And so people have to go through an additional analysis of saying, do I think the LLC is like a corporation or like a partnership, to figure out which guidance I would be in, which I sometimes question. The HLBV element to it, there is the sentence in the real estate guidance, right? It says that when you don't allocate earnings based on ownership percentage, you have to look at the changes in assets and liabilities and your claim on those over time, something along those lines. You have the exact wording. I think that's effectively what HLBV is. It's saying that there's might be an ownership interest, but because your allocations don't relate to the ownership interest, you need to look to something else. I don't think that's unique to LPs and LLCs. I think that's often present in some corporate structures, right? And there's structures all around the world. So part of it is that since that guidance only rests in the real estate guidance, do we think it should be applied more broadly to all types of equity investments when you're thinking about those? I kind of view this, even if we don't want to make major changes, we have a little bit of a mess in the sense that we have equity accounting guidance and we have industry specific real estate guidance that, rightly or wrongly, people say you have to apply to other structures. And does that make sense? Or should there be really two different models depending on whether you have real estate as the underlying investment or you don't? I would have thought we would pull them all together, and if there was a way to do that and make that clearer so that it's almost a fair set of rules, that makes sense. And then I think if we want to touch either the assumptions or the thresholds for equity accounting, that's something we could explore. And if we want to talk about, these disproportionate earnings allocations, do we want to either be clear that you can't just rely on ownership percentages if that's not how you allocate profits and cash flows? Or do we want to rely on something that's more substantive? In some cases, I will tell you with some of these structures, if somebody doesn't do HLBV, I don't know how they do it. They're pretty tough, but maybe there are other ways, and if there's other ways, I think that's great. So, okay, Sue.
Thanks for that. That was helpful. And I appreciate the staff's tee-up. I thought that it was very comprehensive and complete, which made it also very helpful. I think my experience with this topic, certainly all of the feedback that we've gotten from the ITC that you all have summarized is very similar to what I've experienced in my, in practice when I was still in public accounting. And oftentimes the complexity of the arrangements, applying HLBV, determining significant influence, all of these things that you've identified, is something that I have seen repeatedly. And so I would certainly be very supportive of adding a project to the agenda in that regard. I do think it's a pervasive, I think it meets our agenda criteria. I think it's pervasive. I think that there's a clear problem to solve. I do agree with what your objective would be in adding project to the agenda. I think that, in terms of what the solution perhaps could be, I think you've identified some potential solutions that, could be applied in a cost beneficial way. I personally, I appreciated in the memo that you highlighted a number of the past efforts of the board, of various boards over time. And for that reason, I probably wouldn't pursue a path 6, because I do think that, that has been tried in the past. And I think it doesn't get to necessarily the root cause of the issue. I would be interested in a path 2 and a path 5, much like to your recommendations, open-minded to in path 2 to a subset of investments, or in path 5. I think in my experience with HLBV, it's not even just the it's not even that they're applying HLBV, it's just that the actual calculation is incorrect. So there's so much there in terms of, if we were just to do some maneuvering, I think adding some implementation guidance and examples would be important. I would also be open to path 4. I do think that the notion of this counterintuitive results because of different thresholds, I think, is problematic. So I would look at that as well. I think that to the extent we could improve that, that could have a significant bearing on the solution overall, in terms of how they, while these paths are considered in a bit of a silo, I do think there's interaction between all of them. So that will be the magic of trying to put it all together. And then on question 3, I would, the only 2 things I would say is, once we kind of have an idea of the potential solutions and what we're proposing, trying to understand investor views, particularly on how it interacts with the information they'll get on whatever potential solution will ultimately come out with, I think will be important. I think the challenge here is, I'm not sure that they're as interested in the mechanics of how we actually calculate one thing or another. I think they're interested more in what the outcome is going to be and how it will affect the information they get, or whether they'll need incremental information. So I think that there's some finessing on the timing to make sure that we can go with them with, the solution that we think will work. And then the only other thing is, from the moment we put in the measurement alternative in topic 321, 321, we've gotten a lot of questions over time. So I would just do some perhaps incremental outreach, maybe refresh on the operability of that, whether there's any improvements that need to be made there.
Okay, thanks, Sue. Joyce.
Thanks, Rich. I'd like to thank the staff for the memo. I thought it was very well written, and the issues laid out quite succinctly. What stood out to me is that, based on the feedback in our agenda consultation, there were many stakeholders, including investors, who noted that the equity method provides useful information to investors, notably in select industries and in specific situations where the equity method investment is integrated in the operations and the business model of the investor. Albeit there is investor sentiment that the equity method requires broader context and greater transparency about the investee. Investors want to know more about the investee's debt, their cash flows, and other financial performance information about the investee. Clearly, we're not addressing that here, But I do think it's important, to the point that Sue made as well, that we understand what the implications of whatever we decide today would be to investors. And so I highly recommend that we talk to them about what they think would be their new analytical considerations as a result of any changes that are made. But be mindful that there are concerns that they've expressed beyond what we are addressing today. I think the lens that the equity method provides into the investee's continued financial performance helps to capture the economic substance of the investee. However, we don't have investor feedback indicating that a measurement alternative approach that essentially provides a cost basis less impairment approach would be more decision useful for them. And so again, we really need to understand if that measurement alternative would be decision useful to investors. I can't emphasize that more. In my view, the measurement alternative, if permitted, should not be applied broadly. It should be applied to a subset, because if applied broadly, the financial statement, in my view, would not depict more relevant information. It would not depict more faithfully representative information of the investee than under the current equity method. So I think based on my assessment, I do not support paths 1. I don't support path 2 with a broad application. I do not support path 3 nor path 6 for the reasons that you've mentioned in your tee-up, as well as what Sue has mentioned for those paths. However, the challenge that investors in partnership form entities face today should be addressed. I think our stakeholders in their feedback, they made clear that applying the 3 to 5% threshold often results in unintuitive outcomes. And it's largely because the threshold is being met not as a result of possessing the characteristics of significant influence that we've identified in our COD as considerations for significant influence, looking at the true substance of the arrangement to determine whether or not there's significant influence versus a quantitative trigger. Therefore, I would like to add a project with the attributes of paths 4 and path 2, but that is to identify whether there is a subset of equity method investments where we would apply an alternative to the equity method of accounting. In addition, I would like to evaluate the significant influence and whether the presumptive thresholds for significant influence are creating unintended, unintuitive outcomes for those partnership entities and other affiliate type arrangements. I would like the project to focus on depicting the significant influence characteristics under GAAP in paragraph 323.10-15.6, as if those were applied to those presumptive threshold type entities. I think this approach could also potentially address comparability issues with similar equity investments that are currently applied under topic 321. In addition, under IFRS, an investor evaluates significant influence in partnership form entities using the same criteria as in corporate form entities. So I think this is an opportunity for us to increase global comparability between GAAP and IFRS. Regarding path 5, I support the staff recommendation here to add the guidance in 970 to subtopic 323. I also support adding an illustrative example However, since the HLBV method is based on a proposed SOP and is not defined nor detailed in our COD, I think we should consider whether we should specifically reference HLBV as a method, or instead just generally illustrate the characteristics of HLBV in determinations of the equity method earnings when a non-pro rata profit allocation is in place.
Okay, thanks, Joyce. Marcia.
So thank you for the thorough analysis, and I want to thank our stakeholders for the input. I am a supporter of the equity method. I think it's meaningful. I think we validated that through this process as well. On question number 1, yes, I am interested in adding a project to the agenda with the objective of improving the operability of the equity method. I'll try to just summarize. I liked the way the staff presented the views in the tee-up, because I think you went through and you said, okay, these were areas that we do not think works. I mean, I agree with you. Path 1 is not conducive with what I think the objective of a technical agenda project would be, so I dismiss that outright. I agreed with your assessment on path 3 and path 6. For the reasons that you stated, I have a concern about path 4. Conceptually, I think it's worth exploring, but I'm concerned about whether it's pragmatic to think that we're going to be able to accomplish that. So I think that leaves us with what you've recommended, which is narrow. I agree with targeted thoughts. I've had experience with a complex income allocation process in a prior life. And if we can simplify that, I think that would be very helpful. So I agree with the objective of taking a look at that. I also agree that when we have, when in operation, the whole system is trying to analogize to something that's within industry guidance. If we find that that model either could be tweaked so that it could be more broadly applied, or if we find that that model is working, but we've narrowed it by making it industry guidance, I'm very comfortable with looking at that. I don't think we need to introduce another model necessarily. I think we should try to have something that's not industry specific, but possibly more broadly applicable in certain circumstances. So I think where we are today is not trying to describe what that could look like. I think we're trying to describe that may be a goal, and I'm comfortable giving the staff marching orders to go see what you can bring back to us that we can consider for specifics. I think that answered the questions.
Okay, thanks, Marcia. Fred?
Thanks. And I'd also like to thank the stakeholders for the input that we got through the agenda consult process. I think that it's clear that this is an area that can stand some improvement. I also want to be clear that what I'm not interested in, and what I'm not interested in, is providing options for firms with unconsolidated investments where they have significant influence to provide an option that could provide investors any less information. In fact, I think if we read the newspaper today, investors are looking for more information about unconsolidated investments where there is significant influence. So I think that's important. And I don't think we have yet a solution on that side of the that could improve the current situation. And that's really in line with what Joyce had said. I think we know what investors, where they're looking for more information. I do think, though, I am interested in addressing this issue where there is essentially the 3 to 5% up to where the rules of significant influence. I think that's an area that we heard loud and clear is an area of complexity that doesn't necessarily provide any significant incremental decision useful investors to information to investors. So I am interested in that. So where does that put me on these paths that seem to be going in? Lots of paths. rather than say the ones I'm not interested in, I think the ones that I would be interested in, I think path 4 in terms of outreach with the SEC in terms of the scoping is something that we should pursue once they are answering their phones again. So I think that it's worth having those discussions. I'm interested in path 2 only to the extent that we're looking at the subset of investments that fall into the what is it? Virtually no influence up to a significant influence. So it's that subset. I would be interested in potentially an option. And I do think, per both Sue and Joyce and others, that it's important to reach out to investors about that if that indeed is information that is important to get. And I am interested in continuing to pursue path 5. I can't say that I'm not having audited equity investments in my career, an expert on exactly what this could entail, but I look forward to learning more and getting input from the staff in terms of what might be possible in path 5. Thanks.
Thank you, Fred. Christine?
So what I took away from the earlier discussion we had when I was asking my questions is that there are potentially 2 pervasive problems here that we should consider solving. The first of those being that it's the case that we may be seeing the equity method being applied when it shouldn't be to investments for which the investor does not have influence. And I think that we did receive sufficient feedback that we should take that on as a project and we should address that problem. But I don't think path 2, as it's described by the staff, actually addresses that problem. It might, if it's scoped narrowly, as Joyce and Fred were describing. But as it was described in the memo, it was really just a free choice that we would provide an option to apply the measurement alternative if an entity chose to do so. And so that would create a different problem. We might solve the one problem, but we would create a different problem of entities being allowed to apply the cost method to true equity method investments. And that would be a significant loss of information to investors. So for that reason, I would not support path 2 unless it is is narrowly scoped to address those situations where there's presumption of significant influence, even though there is really no significant influence. But that's kind of a backdoor way of actually addressing the problem. I think path 4 is actually the direct approach to addressing that problem. And that path 4 might include having conversations with the SEC about the 3 to 5% threshold. It might have us going back and reconsidering the guidance that's in the real estate guidance and figuring out if that actually is appropriate even in that context. And it might have us considering adjustments to our guidance to provide more clarity around the sorts of things that Rich was talking about at the beginning of our discussion. So I really think that if the problem is that the equity method is being applied when it shouldn't be, we should address that problem, and that problem is best addressed through path 4. I also think that there is evidence that the complex structures, we just don't have enough guidance to help folks figure out how to apply the equity method when there's complexity and how the profits are being shared across the various parties to the investment. And I think a path 5 where we consider if there's additional guidance that we could provide, whether it be in an example or something more significant than that. I'm open to ideas at this point as to how we might help that situation. But I am vehemently disagreeing with the application of just a free choice to go to cost method accounting. And And I think that that could be very problematic because it would open the door for entities to say, well, when I have equity method investees that are true equity method investees, but there are losses, I'll choose cost method. And when there are profits, I'll choose equity method accounting. And that kind of game playing would be readily available if we were to pursue the path 2 as described by the staff. So that's why, for a number of reasons, I would not support that. So I think that's, yeah, I think that's all that you needed from me. Okay, thanks.
Great. Thanks, Christine. Hillary?
I want to appreciate all the feedback from our stakeholders as well as our staff and their analysis of this issue. And when I kind of take all of the feedback that we got on this issue, it really does, at least to me, seem to synthesize down to not all equity method investments are the same, right? It seems like we're hearing that from a preparer perspective of, doesn't seem like we have these two different thresholds of the virtually no influence for the limited partnerships versus significant influence for corporate entities, the challenges associated with applying the equity method and the costs associated with that for things where you don't have significant influence, but you do have you're above the virtually no influence threshold. So I certainly think that the paths that the staff put together all are potential ways to address the concerns that were raised by our stakeholders. I do think that if we look at it, though, from a root cause perspective, it does seem like the question really is more focused on, do we have the appropriate scope of investments that are in the equity method, right? So I certainly would be supportive. One, I'm very supportive of adding a project to the agenda. I think we have met all of the criteria in order to do so. I certainly would be supportive of a path 4 or a path that looks at re-looking at the conclusion of what investments should be applying the equity method, specifically re-looking at whether the virtually no influence threshold should be retained for partnerships. And if we decide that partnerships, LLCs, and corporate entities should all be applying the same threshold, and that's a significant influence threshold, I do think we should look at the criteria or the characteristics of significant influence to ensure that that incorporates things like limited partnerships and other things that weren't included as part of that list as well. I also think that, and I think about when the regulator put in place the guidance to say that the virtually no influence, threshold should be viewed as, anything above, 3 to 5% or above. That wasn't a period of time where we didn't even have ASC 321. Right? That was when, if you weren't applying the equity method, you're applying the cost method. So I do think that it is appropriate to kind of relook at it in the context of, we do have, if you're not applying the equity method, you would be required to apply 321 potentially. And that is not necessarily going to always be at cost, right? You're applying, even if you don't have a readily determinable fair value, you would have to be applying the measurement alternative, which would mean if there are transactions in the marketplace of yours or a similar investment, you would be marking those to fair value. So I do think we're in a different place with regards to the potential outcome if you're not applying the equity method. So I think it's appropriate to take a look at that threshold. Now, in a circumstance where, let's say that we don't end up making broader changes to the scope of the equity method, I still think that a path 2 would be a viable option or a viable alternative for having certain investments that are currently meeting the equity method guidance to be accounted for under either, apply the fair value option and receive a measurement alternative, or apply the guidance in 321, which allows a measurement alternative. I think the important thing there for me is, if we would end up in a path 2 model, is making sure that regardless of which of those different ways we would go about it, that we're ensuring that the disclosures are appropriate for investors to make sure that they're still receiving decision useful information associated with those investments. So certainly very supportive of looking at this at, I think a little bit more of a broad perspective, but really keeping that in the back of our minds. Also very supportive of looking at path 5 with regards to the complex allocation structures. I also have had the privilege of getting to audit these, and certainly think that just being able to have some additional clarity that the guidance that's in 97323 that everybody analogizes to, bringing that into the general equity method guidance, I think would be valuable. So I'm completely comfortable with that. I think the question for me, though, is how much further are we going to go with regards to providing or addressing any practice issues that may exist with regards to how people apply, HLBV today. I'm open to looking into that, but I also don't necessarily want this project to become a science project of exactly how do I do HLBV when I have these type of structures, because I think for many people who've looked at these, they're not the same. Every structure is different, and I'm not sure we're necessarily going to be able to come up with kind of a step-by-step of how to do HLBV, but absolutely open to, if there are very common questions or threshold questions that should be answered, are those things that we should be addressing. And I think, one other thing just to think about, and I guess when I think about my openness to a path 4, I'm going back beyond. But when I think of a path 4, I think there is then the question of making sure we do bring into 323 all of the guidance related to limited partnerships, right? Kind of, we have the industry specific guidance. I think it would be really important to make sure we have one place, a one-stop shop for anyone who's looking for equity method guidance from an investment perspective, looking at 323 and kind of truncating what's in 970 to be able to make sure we have that one-stop shop for equity method guidance. All right.
Great. Thanks, Hillary. So I am interested in adding a project, maybe just to be clear on a couple points. I'm not interested at all in path 1 and path 3. I think we've pretty clearly heard the equity method of accounting does provide relevant information. I think at one point in time, there were some who thought there was a binary model of control or not control. And if you controlled it, you consolidated it. You didn't control it, you account for it at fair value. I don't think that's where we are. And I think we've heard pretty good feedback from investors that they value the equity method of accounting. If anything, I think it calls into question why we permit the fair value option for equity method investments, particularly when the securities aren't traded in a market. And, in some ways, the measurement alternative, in my mind, gives you a less biased answer than the fair value option. Simply take the example of, you have an equity method investment that's doing R&D. Every time you fund that R&D, you're going to book a gain. I don't know what accounting that is, but that doesn't make a lot of sense to me, considering if you did the R&D on your own, you'd have an expense. So I don't know that there's support to revisit and restrict the fair value option, but to me, that actually gives you a worse answer. So not interested in path 1 and 3. Path 6 on simplifying the equity method, it sounds great until you try to do it. And I think the board's had numerous instances where they've tried to do it. And by doing it, you effectively break the contract with what the equity method is. I think the fair value option was the choice, right? It was, hey, if you don't like the equity method accounting, go do the fair value option. Well, nobody likes that. So they stick with the equity method. But I don't think pursuing that makes sense. So what do I think does make sense? I think primarily it's derivations of path 4 and 5. I do think the gating question for us is for non-traditional ownership structures. Do we think it's one method of significant influence for the entity, or do we think it's the ownership unit of account? The ownership, you get credited to your unit of account. I think that's our gating issue. I would say GPs are different, but I think we should look at LPs and LLCs and make the decision for both of those, because those are fairly common structures. And I think we should do it in a way that it will translate to foreign ownership structures, because they don't necessarily follow the US LLP and LLC structure. So I think as we do that, we should just think about that broadly on if we're going to have one threshold for significant influence, is it for the entity as a whole? If we decide we're going to have something else, I think we need to be very careful how we define it. The other is I do think most of the equity accounting guidance that's sitting in the real estate guidance today should be moved. And the reason I say that is I think effectively people have to apply it to non-real estate structures when there's disproportionate sharing, when there's LPs. And I don't think that's really fair to label something as only applicable to real estate partnerships and then somehow they have to apply it elsewhere. If we think that's the best accounting, whatever is there, I think we should pull it in, and particularly the issues on disproportionate profit or loss, or the presumption that a GP always has significant influence, which I think is something that we're going to have to address. The reason I mentioned 4 and 5 is I think by doing those steps and looking at 4 and 5, we will likely narrow what equity accounting applies to, which means I probably have less interest in path 2. If we don't, then I've heard some ways people might say maybe there's some subset we should go look at a path 2 for. And I'll go with it with my bias that I actually think the fair value option for an equity method investment is worse than the measurement alternative. So unless it's publicly traded. So I might be interested in doing something there if we do that, but I would hold that as a fallback. As when it comes to disproportionate earnings, when I joined AXEC, they had just dropped their project on hypothetical liquidation on book value. And they had a great document that told you exactly how to do it. They designed it solely for real estate entities. And my own view was when they dropped it, one of the key issues was there was an SEC observer who said they would apply it to all entities, but AXEC hadn't developed it by looking at all entities. But it's used, and by default, it's become used by all entities in some of these complex allocation structures. I don't think we're going to want to take in, if you haven't looked at the SOP, the draft SOP, I'd say go back and look at it because it's pretty good and it gives you a great overview of what it is. I can't envision that we will take that draft SOP and put it in the COD. I don't envision that practically happening. But I do think we can put some more words around what's currently in the real estate guidance on disproportionate allocation of profit and losses and make it applicable to any entity where ownership interest is not how profits are allocated. Because I think that's the point we're trying to get to is you can't use a non-substantive basis of allocation of earnings under the equity method when they're not substantive. It doesn't make any sense. You have to look to something else. So I think that covers it. So it's really the derivation on 4 and 5 I'd like to hear more about and get educated with my board members and so we can make some decisions. But 2 more is a fallback depending on where we go with 4 and 5. Okay. All right. So I think that gives you enough on our first issue, right? And now we're going to move to the alternative energy structures.
Yes. So thanks, Rich. I will first tee up the accounting for the non-consolidated tax equity investments in a renewable energy partnership, and then Ali will tee up the sponsor accounting for those arrangements. So as noted in paragraph 13 of the handout, investors in renewable energy partnerships provide funding through limited partnership interests in return for tax credits generated by the project. These arrangements are often accounted for under the equity method, whereby investors typically have to calculate their share of earnings in the investee by using HLBV because they have complex allocation structures that we've just discussed. However, if certain criteria are met, an investor can elect to apply the proportional amortization method, or PAM, in subtopic 743.23. The criteria to qualify for PAM include that substantially all of the projected benefits of the arrangement are from income tax credits and benefits, and that the investor's projected yield based solely on the cash flows from those income tax credits and benefits is positive. Under PAM, an entity amortizes the cost of its investment in proportion to the income tax credits and benefits allocated to the investor and recognizes that amortization as a component of income tax expense. The ability to elect PAM used to be limited to investments in low-income housing tax credits only. However, in March 2023, the board issued update number 2023-02 to expand the application of PAM to investments that generate income tax credits and benefits from different tax credit programs. Feedback on the amendments in that update was generally positive, and stakeholders supported allowing entities to elect to account for economically similar transactions consistently. However, some stakeholders provided feedback that the board should have expanded the population of investments that would be eligible for PAM by modifying the qualification criteria. Specifically, stakeholders indicated that certain types of tax credit investments, particularly those in renewable energy partnerships, are not likely to meet the substantially all criterion and the positive yield criterion. And this is because those arrangements are typically structured to include a certain amount of cash flows to the tax equity investor. Respondents to the ITC identified a number of challenges related to the accounting for renewable energy partnerships. The key challenges faced are described in paragraph 16 of the handout and include that the accounting for tax equity investments can be costly and complex, the use of HLBV results in financial reporting that does not reflect the economics, and certain types of tax credits are not eligible for PAM, either because they do not meet the criteria to qualify for PAM, or because they are related to non-income tax credits, for example, state premium tax credits in the insurance industry. Because many of these challenges relate to the application of HLBV, stakeholders generally supported a project other than related to HLBV. Respondents suggested that the board pursue a project to expand PAM or allow an approach similar to PAM. Therefore, the staff has focused its analysis on whether a project related to PAM would meet the agenda decision criteria. The first criterion is whether there is an identifiable and sufficiently pervasive need to improve gap. The staff notes that feedback on PAM was primarily concentrated in the financial services industry, and therefore this issue does not appear to be pervasive across different industries. Moreover, the feedback from respondents on the ITC was generally similar to feedback received during redeliberations for Update 2023-02, including that the board should change the criteria to qualify for PAM because some investments do not qualify. Therefore, the staff does not think that respondents provided new information, and for these reasons, the staff questions whether there is an identifiable and sufficiently pervasive need to change gap. As it relates to the next criterion, whether there are cost-beneficial, technically feasible solutions, respondents primarily suggested 3 potential paths forward that are listed in page 17 of the handout. Under PAM Potential Path 1, the board would explore amending the quantitative criteria to qualify for PAM. As previously stated, similar feedback was received when the board issued Update 2023-02, and therefore the staff thinks that feedback on the ITC does not represent new information. Additionally, the staff considered the presentation requirements for PAM that require an investor to recognize the amortization of the investment in income tax expense. Under current requirements, the staff thinks that this outcome is appropriate because substantially all of the benefits from those arrangements are from income tax credits and benefits. In contrast, the staff thinks that amending the criteria to allow investments that do not currently meet the quantitative criteria to qualify could result in inappropriate amounts being recognized in income tax expense. And for these reasons, the staff does not think that PAM Potential Path 1 is a cost-beneficial, technically feasible solution. Under the second path forward, listed as PAM Potential Path 2, PAM would be amended to allow other types of tax credits, such as state premium tax credits, to qualify for PAM. The staff notes that these tax credits are not related to income taxes, and as previously stated, PAM has presentation requirements that the amortization of the investment be recognized in income tax expense. Therefore, the staff does not think that this path would be a technically feasible solution. So lastly, a number of respondents on the ITC suggested that the board develop a model similar to PAM that would apply to those investments that do not currently qualify. Under this modified model, which is PAM Path 3 in the handout, an investor would amortize its investment in a manner similar to the one used in PAM, but the investor would allocate that amortization between pre-tax income and income tax expense in proportion to its non-income tax related benefits and income tax credits and benefits. However, stakeholders differed on what that lower threshold to qualify for this modified model would be, with suggestions ranging from 50 to 75%. This modified model would have the benefit of providing a simpler method to account for investments that currently do not qualify for PAM. Additionally, this model would avoid the concern of recognizing the full amortization and income tax expense when substantially all of the benefits are not from income tax credits and benefits. Therefore, the staff thinks this solution could be technically feasible. However, the staff questions whether the value of that information would diminish if the threshold to qualify for this model was too low. As such, if the board were interested in pursuing this path, the staff could do outreach on what that lower threshold would be. So the last criterion is whether there is an identifiable scope. As it relates to PAM Path 3, which is the solution the staff thinks could be beneficial and technically feasible, a new threshold would need to be established in place of substantially all. While the staff thinks that establishing a new threshold would not prevent a potential project from having an identifiable scope, the staff does anticipate that whatever new threshold is selected, stakeholders might ask for that threshold to be lowered further. So in summary, the staff does not recommend that the board add a project to its technical agenda related to PAM. Most notably, the staff does not think that there is a pervasive financial reporting need to change gap. If the board agrees with the staff recommendation, the staff will document that feedback and how it was considered as part of the agenda consultation report. However, if the board does decide to add a project to its technical agenda, the staff thinks that the board could pursue Path 3 because the benefits for that path may justify the cost. The staff thinks the scope objective for that project would be as follows. The scope would be to develop an approach similar to PAM for equity method investments made primarily for the purpose of receiving income tax credits and benefits that do not currently qualify for PAM. And the objective would be to improve financial reporting for equity investments made primarily for the purpose of receiving income tax credits and benefits. And so I now hand it to Ali to briefly go over the feedback and staff analysis for the accounting for sponsors in a renewable energy partnership.
Thank you, Ashley. The sponsor in a renewable energy partnership typically has a controlling financial interest and will consolidate the partnership. GAAP provides no specific guidance on the method to allocate an investee's earnings between its controlling financial interest and non-controlling interest holders in complex allocation structures. In practice, sponsors also often use HLBV by analogy to perform that allocation. A few respondents to the ITC provided feedback that the board should expand the ability to use PAM to the sponsor of a renewable energy partnership. Sponsors of a renewable energy partnership currently are not permitted to account for their interest in the partnership using PAM because consolidated investments are scoped out of that subtopic. Because only a few respondents to the ITC provided this feedback, the staff thinks that this issue is not pervasive. Additionally, the staff observes that the reason cited by those respondents for extending PAM is because they do not think renewable energy partnerships should be consolidated by the sponsor entity. Therefore, the respondents' underlying concern appears to be related to consolidation, and allowing sponsors to apply PAM without changing the consolidation guidance would require a change to the scope of subtopic 740.323, which the staff thinks would have broader, unintended consequences. Therefore, the staff thinks that this feedback does not warrant further research related to PAM. If the board agrees with the staff recommendation, the staff will document the feedback and how it was considered as part of the agenda consultation report. And with that, I will hand it back to Rich for discussion on questions 4 through 7.
Great, thank you. Any questions? Okay, so.
So as it relates to question 4, I do not want to add a project on PAM at this time. I think, Ashley, you did a great job of articulating each of the paths and why it necessarily wasn't pervasive or couldn't necessarily be applied. I think, particularly as it relates to path 1, we spent a significant amount of time in 2023-02 and prior to that, even when we talked about LIHTC back in the EITF years ago, talking about this. And so I think that, we've certainly considered their concerns, and I wouldn't want to expand those criteria. It seems like that would be in search of an outcome instead of actually developing a principle. So I wouldn't be supportive of adding a project on PAM. I also equally would not be supportive of adding a project on the or doing further research or adding a project on the accounting for sponsors in a renewable energy partnership, much for the same reasons that Ali just articulated. I think that, it's not necessarily pervasive. Thanks.
Okay, thanks, Joyce.
I agree with the staff recommendation not to pursue a project at this time. I certainly appreciate the staff's view that this issue is not pervasive. It relates to specific structures. It does not affect different industries, nor a variety of tax credit programs. So I certainly agree with the rationale. In addition, I agree with the staff not to perform any further research on the sponsors of renewable energy partnerships.
Thanks, Joyce. Marcia.
I also agree with the staff position on all of these questions. I still remember very fresh the conversations we had when we did the update recently about the other tax structures, and I still support that. I think that was a very helpful set of guidance. So I agree with the conclusions at this time. Thank you for bringing it to us to consider because it is somewhat related to the other topic that we're talking about, but at this point, I don't think there's a pervasive need.
Okay. Fred?
Thanks. I'll take the other side of this. In terms of pervasiveness, a few issues. Number one is that I think, as we discussed last week, we're fairly flexible on pervasiveness. As a board, I would say also that, as you said, this affects the financial services industry. I think we do a lot of projects that are fairly specific to the financial service industry, and say that because it's only financial services, it's not pervasive, doesn't seem accurate to me. The third issue, I think, in terms of pervasiveness, we do continue to see a problem in financial reporting relative to these tax credit programs. And that's because if they don't qualify for the proportional method, it creates, of course, above the line expense that's very significant. That expense, we have heard fairly consistently, changes the efficiency ratio of those financial institutions who make that investment. And that has, I think, a number of stakeholders have said that reduces the investment in these tax credits because of that. And so I think there is, on a pervasiveness standpoint, I think it's hard for me to argue that it's not pervasive. I think there is pervasiveness and there is an issue. Now, I do completely agree with the staff on the paths. As Marcia said, we've been down this before, and I don't want to adjust the criteria because I think that was very clear. I am interested, though, in the path 3. I would, my choice would be to explore that because I think that could give us potentially a solution to this problem that wouldn't directly affect the criteria. In other words, we wouldn't change the criteria so things with significant non-tax income would all go above the line or go below the line. It would proportion it out. So I would be interested in exploring that approach. I also agree with the staff, though, on the other issues. I would not explore on questions 6 and 7. I would not go in that direction. So I do agree with you. Thanks.
Okay. Thanks, Fred. Christine?
That was interesting. So I struggle with pervasiveness on this issue, although I think your points are well taken, Fred. So it's probably not relevant at this point anyway. But I certainly would not take on a project to extend PAM just outright to these types of investments. It's not designed for investments where there are other types of benefits. PAM is just designed to pass through, where we have a pass through of income tax benefits to the investee. And applying that method to investments that provide other types of benefits, I just think is outright inappropriate. So if we were going to take on a project, it would have to be a Path 3 type project where we come up with a different type of model. For these, I would view them as almost hybrid type investments. I don't think that that's going to be an easy thing to do. I think it would be pretty costly and it would take a lot of staff effort to figure out what that model should look like. So I think where I end up is just don't add the project. I just can't see that there's a good cost benefit trade-off there in terms of the amount of time and energy that we would have to invest.
Thanks, Christine. Hillary?
Sorry. Rich, can I just, sorry, Christine, can I get your vote for the sponsors?
Oh, and I would not look at that.
Hillary?
I agree with Fred with regards to, I do believe this is actually a pervasive issue for the financial services industry. And I think we heard that pretty consistently through the comment letter feedback and through other means. And certainly this is something that has been brought up for multiple years, right? Because they were very actively involved in the discussions with the EITF on our last project that expanded the use of the proportional amortization method. But I do differ from Fred in that, although I do believe it's pervasive, I'm not interested in further pursuing standard setting at this time. Certainly, I think we've already gone through the discussion of whether or not the thresholds that are in the existing PAM guidance should be lowered. And I think there was a lot of concern with regards to what would you have to lower it to in order to get some of these renewables into the scope of it. And I think that then starts to really beg the question of when you're getting to like a 50% threshold, well, do I really think that that should be then recorded as part of the income tax line, right? Or should that be above the line? And I think this kind of gets into a broader question of when you start to have kind of that, when substantially all of the benefits aren't coming through taxes, having to kind of split that. I'm not sure I'm interested in a broader model that would be looking for that. So certainly I'm not interested in the paths that the staff had potentially suggested. I think we've heard a lot of those arguments, and I continue to believe that the thresholds that we have are workable, even though they don't include all of the different investments that I know folks would like to apply the proportional amortization method to. Also, I'm not interested in further looking at the accounting from the sponsor perspective. Understand the concerns that were noted by the couple of stakeholders that did that, but it really does seem to be more focused on the outcome that the sponsors generally consolidate and looking for an alternative model, but I don't think this is an area that we need to prioritize at this time.
Okay. So I also wouldn't add a project at this time. I agree. I think it's pervasive, but I don't see a solution that in my mind works. Couple things on that. The income tax line, I think, is supposed to be for income taxes. And we've kind of stretched that a little bit with the original PAM model. But I think at some point in time, putting more income potential in the tax line, all it does is muddy up the tax line. And I understand there may be some banking measures. It sounds like there's more an issue with those banking measures than there is with what we put in taxes. That would probably be my view there. You know, taken to an extreme, you could argue the corporate jet ought to go in the tax line because they get accelerated depreciation on it and no revenue. So, you know, where would you draw the line? So no, I wouldn't expand it. I do think it'll be helpful, though, when we go through and we decide what significant influence is on these pass-through entities, to figure out for these structures that don't qualify for PAM, do we think that the investor has significant influence under the whatever model we come up with? Maybe they don't. And if they don't, and they go to a measurement alternative and they continuously impair it, they may get something fairly close to PAM, albeit they won't like the geography, right? It might be up above the line. So I think that's something to look at. As far as the sponsor, complex profit allocations between controlling and non-controlling interests goes well beyond the sponsors of these entities. That's a broader issue in my mind, and whether we want to revisit allocation of income loss between controlling and non-controlling interests. Maybe we'll come up with a really great solution on equity method investments, and that's something we'll want to go look at. And maybe there's something we'll learn there, but I wouldn't do it solely for this industry. I think that would be a broader decision for the board to make at a different time. So for those reasons, I wouldn't add it, but I do think that the project that we have added will be informative to us on these structures. Whether that will convince the majority of the board ever that they want to put pre-tax income in the tax line, I don't know. Don't think so, but it's always something we could consider. Okay. So with that, team, do you have everything?
Did you mention the sponsors?
I
You did.
did. Not interested at this time. Okay, everything the team needs for today. Thank you very much, team, and all our stakeholders who gave us input. I look forward to seeing you back in the next few weeks. All right. Thanks, everyone.